Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. It's big options expiration Friday today. And I have no clue what's going to happen. We had a lot of big selling going into it, so I guess we might see some more going into it as all the CTAs get triggered. At least that's kind of what my analysts are saying. But I mean, that just seems like such a big drop. I don't know. It's happened before, though, and it's happened before in this. You guys remember 2018? That was a little bit different. Let's go to the charts first. Then maybe we can talk about that. Oh, I got more rollovers? Let's do that first. Yes, I would like to roll over, in fact, I would like to roll over. roll over. Okay, so, well, the treasuries, surprisingly, have actually been, like, pretty sideways-ish, I guess you could say. But the S&P 500, man, puked hard yesterday. And look at here, I mean, it was down pretty good in the overnight session yesterday, and then while we were trading, got hit pretty hard, and then continued down going into the close, and now another decent move lower overnight. And once you're below 3,900, like all of the key CTA levels where like the momentum kind of tries to pile on have been triggered. Although I would note that it seems like every time that we get to that point where all the CTAs are triggered, like it flips around. But you got that going on, and then there's just like massive options expiration. Like all of the gamma was at 4,000. But I don't know. I kind of feel that with that big downturn, chances of us getting back to 4,000 probably pretty low. But that's where we're at. Oil taking a hit overnight. Natural gas is all over the place. I mean, they had a big jump at the beginning of the week, right? Gold and silver pressured, but trying to recover. Kappa looking a little down this morning. And then Bitcoin giving up all of those gains from earlier in the week and dipping below 1,700. And I continue to see things about Binance that make me not want to be in the cryptocurrency market. I mean, it's all speculative, but basically there's a lot of things to suggest that Binance is not solvent. So that's where that's at. And the dollar, make the dollar out big here. Still having trouble staying above 104, but it's within reach. So we could still have a battle over that. You tend to get a lot of big currency moves going into the weekend, and with the options expiration on top of that, I'm sure we could see some interesting things. So that's kind of where it puts us at. I can't help but notice the similarity between this situation and 2018/2019. Although I would say that this is a very much a different situation. So in December of 2018, the market was not looking so hot. I mean, October had been a really, really ugly month. And then December came along and the data just wasn't looking very good. So when they had the Federal Reserve press conference, we were all kind of thinking, well, maybe the Federal Reserve needs to back off. But instead, they increased interest rates 25 basis points. And a lot of people said that was incorrect, that was wrong, and we were all freaking out. That's where, when you're watching the intro in the morning, like at the beginning of the stream, and I'm saying everybody's freaking out and you don't think that anything is wrong, that was me commenting on Jerome Powell's comments at the press conference in 2018 going like, this is nuts. Nobody here in the market thinks that you should be raising interest rates 25 basis points, and you did it anyways. And of course, what happened was the market just threw a complete fit through the rest of December. Like, I was like, after the press conference and the options expiration, I'm probably, going to go on vacation. I'm not going to trade it. And then there was like massive moves. Markets declined like, I think 10% in 2 days. I'm not always on board with whatever the Fed decided to do. I can understand why they might make decisions, and I might be able to come in and say, well, they're making the right choice based on the framework that they're working with and the data that they have, but I know that it's wrong. I mean, I have the discretionary power to say that, and it does happen on occasion, right? It's just up until yesterday, I'd say. I wouldn't say yesterday. I mean, I was kind of starting to feel like this after, well, okay, there was the non-farms and then there was the CPI, and after both of those and the other economic news that we got in between, then I've kind of been feeling like maybe the Fed is getting the wrong picture here, right? Like the way that I feel right now is that the labor market is not as strong as the Federal Reserve believes it is. I think that they may be getting some false signals from some of their data series that are still kind of screwed up. And so it seems to me like they might be continuing to tighten into what is essentially already a recession. So like, I this whole thing like that they're gonna raise interest rates another 75 basis points. I think that the most, like, the biggest risk, like the thing that would be like really shift the market, and also the thing that I think is more likely to happen than maybe the market is pricing in, is that the Federal Reserve doesn't raise interest rates in February. That's kind of what I'm thinking right now. So I'm not always on board with whatever the Fed decided to do, but I am on board with the Federal Reserve System as it exists in general. Like, I would not say that the system is perfect, and I think that that's kind of the problem, and the thing that is unfair, right, is that people expect that the Federal Reserve has to be perfect. It's kind of funny. Some of the Federal Reserve's biggest triumphs have happened because they screwed up before that, right? They screwed up and then they came in and they fixed it. And when they fixed it, that ended up being one their biggest triumphs. It happens. It's happened a lot, right? I mean, that's what happened in 2019 was like when the markets just like fell apart in December. I came in and I said, well, I'm out of cash right now, but I think you buy this. I think you put as much as you can in that this downturn is going to completely reverse. And it did. It did, up until, then there was the 2020 thing. But I digress. The Federal Reserve is going to make mistakes. That's just the way that it is. But I would argue that the economy is more stable even with the huge mistakes that the Federal Reserve makes. So I think it's incorrect for people to come in and point out the Federal Reserve is wrong sometimes, ergo we must abolish the Fed. No. Sorry. Doesn't compute. You have to be able to come in and say, here is what the market would have been like without the Fed, and here's what it was like with the Fed, and the mistakes that they've made, and the market without the Fed would have been more stable. And I think you would find that the market would not be more stable without the Fed. But you'll also remember earlier that I felt like not last February, but like around May of 2021, I felt like the Federal Reserve needed to start tightening again. And they didn't because of the COVID thing. And I'm like, well, I understand why they're doing that. Maybe that's what they have to do because they're risk adverse and everything. But I don't think that. I think that this market is going absolutely nuts and that you need to step in and do something. Was waiting longer the thing that really screwed everything up? I'm not so sure. Because the thing was like, you know, M2 money supply increased a lot, right? And there's a lot of various reasons why that happened, including fiscal stimulus and fiscal stimulus that was like entirely unnecessary. So like, how much did each factor contribute? I haven't seen a study that is really conclusive about how much each individual policy was. Like the one that I saw that was really interesting was that they were able to say, here's how much inflation we had before Russia invaded, and here's how much we had after Russia invaded, so that they could quantify how much of the inflation that we had was due to monetary policy and fiscal policy, right? And it showed that it was the majority of it. So the people saying that it was all supply chains are wrong. I think that one's been empirically shown. At least there's at least one study that suggests that those guys are wrong, right? So it could have been the case that they started tightening earlier and we'd still be in the same situation. So who knows? But suffice to say, my opinion at the moment is I'm very concerned that the Federal Reserve is being misled by the jobs data. But what we got in front of us today, this options expiration, tough call for me, I think. I mean, in equities, I think that you kind of have to lean towards the downside, with the caveat that a good enough buy in here could really flip all of that around and turn things really positive. For the treasuries, I'm not so sure. I think maybe let's try going to the CME website and looking at the options and seeing if there's anything we can glean from the options in over here. Let's see. I think we want to go to the quick strike tools, right? Okay, let's see here. So if I open up the quick strike tool here and I select, oh, come on. Asset class, interest rates, US rates, 10-year. UIH3. Yeah, I think 2YH3 would be what we're most interested in. And I see 112.5, there is a lot. 114, there is a lot. 115, there is a lot, but that's where they switch, is that they've got calls is starting at 115 and they got puts. They got more open interest on the puts at 114. So that would suggest to me that we stay between those 2 points. So actually we're like right exactly smack dab in the middle where both sides of those guys kind of lose, right? So if it's below 114, we should sort these the other way. There we go. Oh, that's interesting. It doesn't, it's sorted that way because otherwise you can't really see anything. Well, okay. But if we close below 115, then all of those calls get screwed. And if we close above 114, then all those puts get screwed. So the point of maximum screwedness is right smack dab where we are at 114.16. So I don't know if that really helps us any in the treasuries, does it? So I guess maybe we it's all about the equities today. I don't know. Oh, I want to see. So there's this whole thing about yesterday. There was a family member of Elon Musk was attacked by a stalker, and so Elon Musk decided to start enforcing the rules against doxing, and a bunch of journalists were publishing links that still showed like where he was, like real-time location information. So he banned all of those people. But then he created a poll and said, unsuspend accounts who doxed my exact location in real time now or in 7 days. And which one came out on top now at 58.6%? Interesting. Interesting. Oh, we do have Feds Williams speaking. Okay, that's good to know. Inflation is still high in areas of court services. Inflation data is showing good news. Possible Fed will hike more than FOMC terminal rate forecast. He's on Bloomberg television, I guess. I don't see any signs of a wage price spiral reminiscent of the 1970s. You know what? So I have an opinion on this one. I don't see any signs of a wage price spiral either. But what I do see is strong indications that we will continue to see rising wages. Because there is a shortage of workers in all sorts of industries, especially on the lower end. I guess, does that mean that you get what everybody has always wanted, which is that the guys at the top, like the CEOs and stuff, don't make as much, and the people at the very bottom have their wages increased because that's what you've got to do to get more people in the labor force to fill some of these lower end jobs? Could be. Paul Krugman retweets still work. I think that's because he might have been banned. I think it's really weird. Like, yeah, they don't want you to post real-time location tracking information, and all of these liberal journalists are like, that's exactly what I'm gonna do. What the hell? Why do people think that why did anybody think that was acceptable, even if Twitter wasn't going to ban it? So I'm kind of looking around the internet, looking for what interesting things that we have here this morning while we're kind of waiting on. I don't know if Feds Williams is going to say something that really comes in and like shifts the treasury market here. But if he does, we should be ready for it. But I kind of want to come over here and look at this Reddit. So my day trading results tell me to start trading with as much as possible that I can afford to lose. But others say start small and build up. What do you do? Start small and build up, because if you think that you should start trading as much as possible, you're probably wrong. You probably just don't have enough data. Wait, let's see what he actually said. It seems that when starting out trading with capital from $0 to $3,000, I found it difficult to progressively make significant profits, even with leverage. I once added more funds and found it easier to make good trades and have enough margin requirements for any crazy moves. I would never start from a smaller account, say a $100 portfolio, as you do better, you scale up, etc., because it seems a certain threshold amount is required to make that entry into significant profitability for the average trader. So I was wondering why it is recommended so often. No, I don't think that that's the case. After 600 FX demo trades over the course of 3 months, still new to FX. What is your opinion on how quad witching will affect the market today? Well, so I think so. I did already say a little bit about this, but let me kind of expand on another thing that I'm seeing. So yesterday when the market moved down really big, I saw so many people, especially like the people that I see on TikTok that I think are stupid. And I'm like, why does it show these people to me? They clearly don't know what's going on. These guys were all trying to come in and make these big proclamations. See, this means that the economy is bad. I don't know. There's a couple of things where these people that they're not only are they wrong on the fundamentals, but they're wrong on like how the fundamentals move the markets compared to like orders in general. And the thing that I'm really noticing here is that I think the action that we were seeing yesterday in particular probably has more to do with the absolutely massive options expiration than it does anything to do with the fundamentals. And for instance, the treasuries aren't going anywhere. The treasuries are stuck right smack dab in the middle of where it will screw over the most options traders, right? So, the treasuries don't seem to be thinking that something fundamental has changed. It's just the equity index is giving up a lot of the gains that they had that, were maybe not likely to last, or at least we'd come back and retrace those spots. So I do think it's the options expiration that's driving us. Now, if we were selling going into the options expiration, you're probably more likely to continue selling, right? Like, because those people are probably trying to get ahead of the difficulty that they would have otherwise on the expiration Friday, right? And then the other issue is that the S&P 500 moved through points that essentially result in momentum funds, CTAs and so forth, trying to jump on board. So you would also expect to see those guys coming in short. So I think that there's kind of like three scenarios, of course, always. But one scenario is that momentum continues, the CTAs continue to sell, and we have another down day. And maybe we end up somewhere below 38.50, right? The other thing is that they may just be, maybe it's already over and we end up getting pinned to 3,900 and we end somewhere around 3,900. But the other thing is that if we do get a buy, like say the open gets a strong bid, and maybe they're able to break back above 39.20, for instance, then all of those dynamics like flip back down around again, and you could have really strong buying going into the options expiration. So we're really in a situation where I don't think it would take very many orders to kind of pass like these critical thresholds and so forth. So that makes it very difficult for me to predict exactly what's going to happen. But that's why I'm kind of like, you know, when you get into that situation, a lot of the time it just means nothing happens. You know, I don't think that that's how it turned out last time we had such a massive options expiration, but let's just see. I can't think of a time where it moved that much going into options expiration to the point where it's like, are we going to have a 10% move because of options expiration? That's kind of crazy to me. So sorry, it's probably not too helpful, but or kind of in a situation where the flows could shift really quickly, right? Sophie, good morning. Welcome back. Oh yeah, I wrote this comment. Did I put it in there? Anyways. Utah Governor Spencer Cox says the recent snowstorms are a good start, but the next few months will play a critical role in the state water supply. So what you're saying is we need another good 2 or 3 snowstorms like the one that we just had, huh? That was a pretty solid snowstorm, man. And that dumped a lot of snow. Good grief, Wall Street Bets. I had limited funds, so I took out a $2,000 personal loan to trade this week's volatility. Needless to say, it worked out all right. Yeah, now his account is at $18,000. Wow, that's a pretty good YOLO. I don't think that I would ever be able to get myself to make a YOLO like that unless I already was a millionaire, man. Yeah, market is pretty quiet here. I'm thinking we do have some data today, by the way. I should point out that we do get S&P PMIs at 15 minutes after the open of the S&P 500. We also have Fed's Daly speaking at 10 o'clock. I always trade charts. I wonder how and why you use the DOM. Well, so the reason that you want to use the DOM is because, number one, it's easier to enter orders and execute appropriately on it. Number two, it allows you to see the limit orders and the execute off of that. So like if I want to go short here, I want to hit into 17 just as it's about to leave so that, you know, okay, it ticked down. Now if I want, I can scratch that, you know, because it already ticked down because I executed at the right point. So that's the next point. And the third point is that the DOM just gives you the most complete picture of what the orders are actually doing. You can duplicate some of those things on the charts, you know, like cumulative delta is a really good indicator to use to see how, you know, what were the market orders, buys versus sells over a time period. That's useful information. And there tends to be an auto correlation in whether the orders are buy or sell that you're going to see in cumulative delta that you can take advantage of, right? But you can also see that in the DOM, and the DOM is showing you like the most granular level that you can. So that's why I like to use the DOM, right? The sorts of things that I'm looking at, I have a video series about how to use the DOM where I go through all of the different pieces. But the sort of thing that we're looking at is basically, okay, why does price move? Well, it's because the market orders overwhelms the number of limit orders at that price. So there's 350 limit buys at 16. Okay, somebody sold, market sold 312 and price ticked down, right? So I want to see if we tick down, how many contracts did it take, right? When we're getting a lot of market orders in one direction, that's going to move the market. When we get the limit orders on one side canceling, that's going to make it easier to move. So if all of the orders here at 15.5 canceled, that would make it easier for us to tick down, right? And if they put more limit orders on, the more limit orders you add on at 15.5, the harder it's going to be to move. And especially if there's like an iceberg there, it's going to take more market orders to overcome that, right? So each one of those points is kind of like a tea leaf of sorts that you can look at to see what the orders are doing at that particular time. So what I'm doing is I'm trying to predict the orders ahead of time. I'm trying to use larger information I know about how institutional strategies work and supply and demand in the market to determine if there is a situation where there's an imbalance in the market that I can take advantage of. And then I want to see those imbalances reflected in what I see on the DOM, right? So right now, I think that they're going to stick around this 16.5 a lot, probably. And what do you know? That's exactly what we're seeing. They're able to trade into 16.5, 16, but then you notice 63 went into 15.5, and then the buyers came in and started pushing it back up, right? So far, my expectation is matching the order flow that we're getting. I was expected to be probably pretty quiet until the S&P 500 opens, but we'll see about that one. Did you ever end up buying the S&P 2 weeks ago when you were talking about it? I don't remember talking about explicitly buying. So I did put some money to work in the market, but I think that was a month or two ago. So like when we were really low, I got in. So I did benefit from this rise that we've had. I think the issue I'm at now is that I was expecting the flows in December to look pretty positive going into up to the FOMC meeting. So I was right on that one. Then the next thing has been, I didn't really have a prediction on the next step, but the next step was the options expiration. The options expiration has been really ugly, right? So the question now is, what is the result after options expiration? So what you might see, something that we've seen happen a lot rather, is you sell really hard going into the options expiration, and then the next week, all of that gamma unclenches and they go the other direction. So it may be that Monday and Tuesday end up being really positive, right? So that's like the next step after that. And then you go into end of month flows. And the question on the end of month flows is Santa Claus rally / rebalancing versus end of year tax loss selling. I don't know how that one wins out. So I am now more interested in playing this Stories from Zero Hedge, where essentially they've been following this for a couple of months, and Zero Hedge thinks that the employment report, the non-farms employment report, has been overstating in jobs creation by over 1 million jobs. And there was some evidence in the Philadelphia Fed report yesterday basically saying that that was the case, that it was overcounting by 1 million jobs. If that is the case, then that means that the job market is not as strong as the Federal Reserve thinks that it is, and that they've been getting false signals. and that by February, the Fed may have to turn things around. I mean, it does kind of look like a given current trajectory that you're going to get it's going to be pretty ugly if the Fed keeps its current trajectory. So I'm thinking right now, like the play that I'm thinking on the higher time frame is if there's a dip in the first quarter, I want to buy the F out of it. Like I want to aggressively buy any dip in the first quarter because probably then the Federal Reserve backs off and things could come roaring back, right? So that's kind of my outlook right now. But for the trading that we have here, we take it one day at a time, and we're just looking for, you know, in individual imbalances. And at the moment, I don't have a clear one. At least not in the treasuries, unfortunately. There's definitely going to be an opportunity here in the S&P 500 on the open at the very least. It's just, I don't know which way it's going to be. I kind of fear that it's going to be down, but let's see. I don't think that my record in that kind of a situation is very good. But I did buy a little bit more. Most of the money that I put into the market though was like Berkshire Hathaway. So let's see. I'm hoping that at the beginning of the year I get some more cash to work with and I can put it into my IRA. Because the past few months with the inflation and everything have been rough, and I haven't been able to save as much in the IRA as I would like, and I would really like to put a lot more into my IRAs so that I can pay for kids' school. So maybe February will provide an opportunity for us. Yeah, I know. I just can't stand it. When I do these sorts of things, I'm like, should I just turn the camera off? And you made 25 ticks on oil again? Yeah, I was wondering about that the day that you came in and you talked about that. If you had just taken your profits and ran, or if you had held on to it more, because that thing ended up moving like $5. It was like a massive move in oil that day. Apparently, I went back and looked at the history. Apparently, there's been a lot of days like that lately. But man, to me, like the reason why I look, I should learn to hold on. You didn't. Oh, that's okay. That's okay. I mean, the thing is you have to have a reason to hold on, right? Like my thinking is usually like here in the treasuries, I want to make $10 to $20. You know, like that's the natural oscillation of the market. If it's going to move more than 20 ticks, there's probably going to, you know, I probably need to have a good reason to think that it's going to move more than that, right? Excuse me. No, so when I worked for the bank, you know, they don't let you trade futures. Like you're just straight up not allowed to trade futures or do any kind of day trading. Like any kind of stock trade that you make, you have to stay in it for a month unless you lose like 5-10% or something like that. So they kind of set the rules up to force you to have to only long-term invest. But I wanted to trade, So I decided I would do kind of like discretionary swing trades with futures on a spreadsheet. I don't know if the spreadsheet was a fair way of doing it, because like I did crazy well with that spreadsheet, but I kind of think that in some instances I was cheating. I don't know. But the thing that I remember was that it kind of got to a point where it was like I was just kind of like being slow and only risking 1 or 2% of my portfolio or whatever the deal was, right? And then I got a couple of trades that were big. And once I had gotten that and started sizing up my trades, that's when like it started doing really well. And I took an account that was started with 100,000 and I took it to like 2 million, I think is what it was, right? So again, I don't think that those results were probably accurate to real life, but it was a fun thing to do. And one of the first trades that I had done that really did well for me and kind of got me to that spot was catching a full dollar in oil. So I remember at that time in like 2010, so we're like talking 2010 to 2016, right? So in that 5-6 year period, you know, $1 in oil was a lot. So to see them trading $5 a day in oil like every other day is just like so crazy. It really is insane volatility. Where did I said I was an expert in fine? Oh, you're talking about the TikTok. Yeah, you did. I did take that TikTok. Well, so I was just saying it from the perspective of like here on social media, that's where my expertise is, right? Is finance, treasuries, optimal execution. Basically, I was saying that to say, okay, if you're interested in finance in the stock market, then you should follow my account. Certainly, I am not an expert compared to basically any trader at a bank, right? Pretty much anyone in the professional world. But there are some things that we know that even some of the professionals don't know that are really, really valuable. So yeah, you can make a ton of money with oil, man, but you can lose a ton of money with oil too. That one, I still have nightmares about that freaking trade, man. I could go back and find when that was, but I was trading oil. I had like a really big winner in oil, took some profits on it, kept trying to trade it, lost it all because of OPEC meeting. So I was right on the direction. I was like, the oil is going to bounce and it's going to move higher, and I should be able to swing and hold this. And if I had just waited until after the OPEC meeting and like a day, then it would have been the most amazing trade of my career. I would have held it, and then I would have caught the whole Russia thing and all that. Oh, it pisses me off so much, and instead I lost a lot. You come from crypto. I don't know. But the whole thing is the volatility cuts both ways. That was what the point of that was. Well, actually, I think there's two lessons. I already knew that the volatility cuts both ways, right? The other lesson was that oil is a very particular market where it is very difficult to be one of the people in the know. And you really have to study and understand that market specifically, right? Because I didn't know what was ahead of us for the OPEC meeting, for instance. I was kind of blindsided by it. So. For your expertise, should I go all in on Argentina or France? I can't make specific recommendations tailored to individuals like that. Specific trade recommendations can't. Your answer is why I follow you. Oh, thanks. It really is like the issue. I was reading this story yesterday about the way that brands work. Like the reason that the Starbucks brand works as well as it does is because everywhere else wants you to go away, and Starbucks is the one. We're the ones that came in and said, "Oh, okay, then we're gonna make this like your third place. There's your home, you're working now. There's Starbucks. You can sit here and you can use the cafe and you can stay here for long periods of time, and that's Starbucks, right?" And so we kind of have a similar sort of thing going on with our finance, which is the thing that we understand compared to other people on social media is that as much as we might know, it's still only a teeny tiny fraction of the total information available to know in the market, and it pales in comparison to what the true professionals out there are doing. And it's just that the true professionals aren't allowed to speak to us or use social media, so you never hear those guys, right? And that really sets us apart. Of course, you get more views when you act like you know everything that's going on and you're going to make everybody rich. But I care more about cultivating successful traders more than I do how many subscriptions I have on the YouTube channel. Of course, I want more subscriptions on the YouTube channel, but I'm not willing to compromise helping you guys become effective traders in order to do that, right? And that's what makes us different. To me, it's a matter of excellence, right? It's a matter of excellence, and having a big ego can really hamper your ability to be excellent in markets. I never trade news. I'm very technical. Well, I would just caution, first of all, oil is a very news-driven market, right? And there tends to be more informational inefficiency out there than there is technical statistical inefficiency. That doesn't mean that you can't find some statistical trades in oil. I remember one of the things that happened that I thought was really funny was my wife traded one day. She just traded one day on sim in oil, and it was like the one range bound day of the year, and she made like $1,000 on scalps. I was like, what? You made a whole dollar in oil just from scalping it back and forth. How did you do that? Because it trended like every other day that week. It was so funny. And it was literally just like, oh, okay, well, it seems like they're down pretty far, so I'm going to buy it. And it seems like they're up pretty far, I'm going to sell it. And that's all she did. Beginner's luck. Beginner's luck is what she was doing. But yeah, I think that especially in oil, you really do want to follow what's going on in the oil market, and just always approach it with the understanding that it's how is this going to affect the future orders that matters the most, right? Just put oil on stream. Well, the reason that I pulled it off was because we felt like we were having issues. Like the system couldn't handle that number of orders. I think that we might be able to get to a point sometime this year where we can put it up. I don't know. I've found, like, here's the thing is we're going all over the place, but I'm answering your guys' questions, right? The women are better traders according to behavioral finance if you can get them to take the risk. Yes, that's the big if. The thing that female traders tend to struggle with is taking on enough risk. That's true. But that's also kind of why they're better traders. Anyways, I forget what I was even getting into now. Oh yeah, so one of the things I found about the stream is like, so if I come in and I want more oil traders to watch the stream and I put oil up, the thing that seems to really really attract people and get people to stay is if they believe they can shadow you, which is kind of sucks, right? If I'm coming in and I'm saying we're trading oil together and you can all follow me on trading oil, then I'm going to get more people trading oil and they're going to try and follow me. So just putting oil up on the screen doesn't accomplish that, right? Just having the S&P 500 up on the screen doesn't accomplish that. But by the same token, when I was actively trading the S&P 500, and of course I've always told people, I don't want you to follow me. I want you to be making your own decisions and doing your own analysis, and you're only listening to me to understand the kinds of analysis that you might want to be doing, right? And to understand the market as a whole. But ultimately, you get to the point where you're making your own decisions. So I've never taken that approach that some people do, like Matt, where it's like, let's just all do this together, right? So I never got that huge influx of viewers from it anyways. Like the difference between me primarily trading treasuries and me primarily trading S&P 500 futures is like 10 viewers. So it's not a huge change anyways. But I do think that at some point in the future, I may upgrade my internet connection and I may upgrade my computer, and then that would probably allow us to push through more data and have oil up again. How long did it take you to learn the order book? Man, looking back on it, I didn't feel like I really understood what I was looking at for probably a year and a half. It was like after a year or 2 years, I started to gain more insights and understand what I was looking at better. Man, we're getting a pretty powerful sell come into the treasuries here now. It takes a couple of hours. Like I remember watching videos, and it was probably like 2 days of watching videos, like all of the free content that I could find out there and the Jigsaw day trading book, you know, that was like a week's worth of effort, right? But I don't feel like I really understood what I was looking at for a year. And then it took me a really, really long time to come into some of the more advanced knowledge that I felt really helped me understand the order book. So I have that video about the stylized behavior of markets. Proven market behaviors is what it says on the thumbnail. That is probably the most valuable video on the channel, right? Because what it takes you is like there's order flow, and there's like understanding what order flow is and understanding what you're looking at. Then there's the trades that the existing education out there tells you to take that are like technical trades. Like if there's an iceberg, maybe you should buy. If you know there's certain aberrations and large orders that you see out that you could maybe try buying and selling off of that. And I found that the situations are too varied in there for that to really truly work. Wow, what the what is going on? They just dropped another 3 ticks there, man. For almost no reason. Like we were looking at, okay, 16 is like exactly halfway, right? Look at how close we are to 114 now. That's nuts. Oh, let's keep this in let's just keep this on here. I am seeing some counterflow coming in. I'm not going to touch it yet. Anyways, you know, there's the trades that they tell you to make, and I tried doing that for a long time and just didn't have success with it. And when you get into the empirical research, that kind of shows you the things that you know are like things in the market. Like when you look at price, most of what you see in price really is just like a random walk. It's you can't differentiate it from a random walk. And the things that we can differentiate from a random walk in price have mostly to do with volatility. They don't give you direction, right? Whereas in the order flow, the stylized behaviors that we find in order flow are like the autocorrelation in the signs of orders. Meaning, if you see a buy order, you're more likely to see a buy order an hour from now. That there is a very strong autocorrelation with a long memory, like it lasts for hours, right? And that's probably the most useful piece of technical information you can get. We're seeing selling across the board here in the treasuries. I'm not looking to buy this. I'm not looking to buy this, especially since I don't have any indication of news or anything that would cause this move to happen. It just kind of happened out of nowhere. So I'm not looking to buy or reverse this flow. I often was. I'd see an iceberg and be like, okay, here's the reversal. Yada yada. I mean, it does reverse, but oftentimes when it reverses, it's because of like a correlation or a counter trade or things like that. But if I'm seeing cumulative delta consistently moving in one way, I only want to be in line with that cumulative delta. And you can't make as consistent of a decision looking just at the price, right? So that's where, and I mentioned 5 behaviors like that in that video. That's the most valuable information, because that's like proven technical information, right? But I've just found that even with that, trading is really hard, and you kind of need to take advantage of informational inefficiency along with it. And that it took me years to stumble upon that information. So if you watch my channel, I think that I'm giving you a really big shortcut to being able to trade futures, to at least stand a chance, to get to a point where you actually stand a chance of being able to compete, is what I would say. But even with all of that, it's probably going to take you several years to really figure it all out. Yum. Do you think anyone that seeks financial advice on TikTok is... No, of course not. Because nobody even knows that it exists, right? But people do come along and learn those things, and it might only be like 1 out of 1,000 people, but finding that one person is valuable, because you're teaching them things like about how the market actually is that people don't know. That's valuable. And it also, I think, it has some kind of larger philosophical implications, right? Like, we don't know a lot. It kind of teaches us that as much as we might know, the market can still defy you, because it doesn't take very many orders to make you wrong, right? It means that the individual decisions that we make actually do matter. I think people have this approach that the market is always right and it doesn't matter what I do, but what we actually see is that orders have strong impact. The decisions and how we decide to manage our money matters. And from a philosophical and like religious perspective, and I know that not everybody's religious, and I'm Mormon. Not everybody's Mormon, or this is kind of more of a Jewish approach to money, but I think that when you're standing there in front of God, you're going to be held accountable for how you chose to manage your money, including what things you decided to invest in. And I don't think that making the most money is the only thing that you should factor into your investing decisions, right? And if I can teach even one person that, it's worth it. I really don't consider it a quote-unquote different approach. Like, of course, what I say is very different from what most education influencers, etc., will tell you. But to me, this is just the way that it is. This is what they would teach you at the bank. This is what all of the research says. So I don't care necessarily. Well, I only care in as much as I feel like it makes my job more difficult. But, you know, if other people are taking these approaches that aren't in line with the data, like who cares, right? This is what the empirical data suggests. So it's not a different approach. It's the empirical approach. And I'm getting you to a point where you understand the empirical behaviors of the market and the things that there are to know that are provable. I get you to that point much faster. Most traders never get to that point. And if they do get to that point, they somehow stumble upon it on their own through hard experience, and they might not even necessarily understand why that is. They wouldn't be able to explain with math to you why it is that way. I do think that some traders eventually do come to the point, because I've certainly heard people in like webinars and stuff say that, like, you know, you need to think about what actually drives the markets, what actually brings orders into the markets. Come and watch and see what actually does drive orders into the markets, because it's not the things that people think that it is. It's not just purely fundamentals, right? But you know, I can get you to that point on day one compared to people that trade for 5-10 years and never figure it out, right? It is a shortcut. Well, I think that you're okay. So there's a difference between, here is information about the market that we can prove is true. There's a difference between that and here's a strategy. I'm not necessarily selling a strategy, right? In fact, kind of what I'm saying is that everybody's strategy is going to need to be a little bit different, right? And the information that you have available to you, and therefore the trade that you're going to be trying to make, is going to be a little bit different for everybody, right? But so I'm not selling a strategy. If I'm selling anything, I'm selling proven empirical information about the markets that tells you a couple of things that can inform your strategy. But it's still going to be up to you to figure the strategy out and make money. And probably still most people aren't going to make money. I mean, because that's just the way that the market works. Is it's competitive, and only a certain percentage of people can actually truly make money from it. But that's why I said what I'm doing here is I'm giving you a chance, right? I'm getting you to the point where you understand everything about the market that you're really going to need to know to trade, and that we can prove, right? From there, you actually stand a chance at being able to compete and getting to that top 10% or whatever of people that are going to be profitable in the long run, right? I don't think that you're going to really be competitive without that information. So that's why I'm saying what I'm doing isn't going to make you a successful trader on its own. It's just going to give you a chance at being a successful trader. That makes sense? Did you see that move you're talking about in the downside on the treasuries, or are you talking about something else? I'm really curious about what this move in the treasuries is here. It was kind of a little bit too short-lived for it to just be somebody executing some meta order or something like that. Like it really feels like news-driven. 10 minutes ago? I don't know, but we didn't have any news at that time. It's just kind of like Swiss approve EU sanctions against Russia's crude price cap. That's the only thing that I've got on here. There's definitely something going on in the market that we're not privy to. Of course, we're in a better situation now. Like if I wanted to think that we were going to continue to go short and like really after a move like that, unless I know what's going on, I'm not going to be looking for a reversal. I really have to know why it moved down and have a piece of contradicting information to be wanting to take a reversal. I've made some good money on reversals before, but I can't do it. But here at 10 is probably the perfect spot to go short again, just from a risk reward perspective. If we had reason to think that we were going to continue down. Right now, the only thing that we have that would suggest to us that we're going to continue to move down is just that the order flow is definitely to the sell side this morning. Seasonal sell trade. I don't know, man. That was just such an aggressive flow to not be news driven, you know? Nah, I didn't see it in ES. ES is definitely floating around here though, right? I think that here in a minute and a half when the S&P 500 opens, there's probably going to be some fireworks, huh? Because they're going to fight over that open hard. We might be in the presence of toxic flow. I've kind of been thinking about that thing lately, and one of the things is that, like, what is the term toxic flow? Because I think we kind of approached it as like flow that's intentionally there to like screw you up or something like that. But I think that what it really is, or what would be a better theory for toxic flow, would be flow that is contrary to the thing that you're actually trying to make money from, right? So if I'm trying to make money from an arbitrage based on correlation with another instrument, then any flow that's coming in against that correlation, from my perspective, is toxic flow, right? Including informed trading, right? If you think about it, it's about market orders being dropped in the market. It's not only about that. I think we should try and be a little bit more nuanced. Market orders, the sign, whether they are buy or sell, I keep saying that sign. I'm sure that a lot of people are like, what the hell is he talking about? Whether the market orders are buy or sell is the best indication we have of informed trading. Without question. It's something to watch. Like, I think you want to have some form of cumulative delta, or if you don't have cumulative delta, you want like the meters up on your DOM, right? Because that is one of the most, because again, the strongest, the two strongest statistical tendencies that we get in the markets is one, the square root law of meta orders, and two is autocorrelation in order signs. So you got to have that cumulative delta up to see what sign the orders are, right? But the nuance part here is just understand, if I'm coming in and I'm buying like 50,000 contracts in the treasuries, I'm not going to do it all with market orders. Most savvy executors, traders could trade up to half of that with limit orders as well. So you're going to see, you would like to see both market orders coming in and pushing price, but also whenever market orders come in the opposite direction, the bid absorbs them, right? But the situation that I'm looking for is when I'm an informed trader and I know something that the rest of the market doesn't, and I know that other informed traders are going to be coming in behind me. And from the perspective of a market maker, me and our combined flow is going to be toxic flow to them, right? But it's like, here's what, because I think the thing that got us on that one, Lucas, was like, there's a study out there about, like when you search for the terms toxic flow and stuff like that, right? There's that study that has an indicator trying to indicate the probability of informed trading, right? And it's kind of based on like, what is the volume for the candle and did we move up or down? And they were trying to say, okay, like how much does that match the reality or whatever the deal is, right? The reason that that's what I learned much later is that the reason that that study was a significant study was that most researchers did not have access to pure order flow, especially not for stocks, because they wanted to study stocks, right? When you have access to the complete order flow, what do you use for that? You just use cumulative delta. Which is why I said again, cumulative delta is the best indication of informed trading that we have. Maybe there's some other indication of that you can use some math and so forth to kind of just tease out that I haven't seen in the research, or maybe it's only there at the banks, but the tool that we have, the best tool that we have for that is the cumulative delta. I had my mind about aggressive. So wait, what evidence do you have that an aggressive HFT is more profitable than a passive HFT? Because I'm not sure that that's actually true. It could possibly be true. That I think that would be a significant. Okay, I'll get this study. I think that would be a significant discovery if we could prove that. Because I've always had this thing. It's like, is it better to use limit orders or market orders, etc., etc.? And especially since I've started using the micro treasury yield futures, it has definitely been the case that the trades where I'm using a market order do better. Like if you have information and you know that flow is coming, it's better to use the market and start bullying them and pushing them your direction. Is my approach to it. And I'm just like, yeah, of course my one order doesn't matter, but it's just that little bit that helps, and everybody does that. I think that the big guy that comes in, that he's using market orders too for that reason. And that could be a reason why HFT that's aggressive may be more successful. Although I would probably also bet that the majority of market making activity and automated trading that goes on that is profitable is relying on limit orders. So what happens is the house is not informed. They make money on consistent basis, but it only takes one informed trader to bankrupt the house. Same with casinos, right? Well, maybe not bankrupt, but yeah. The risk to the market making strategy is the informed trader, which is why they put all of this effort into analyzing the flows that are coming in and analyzing them for the probability of informed trading and adjusting their bids and offers to account for that possibility, so that they can maintain net profitability over a long time period. I'm, on Twitter, because we're on Twitter and constantly looking at things on Twitter, and I'm constantly frustrated or disappointed in the subjects that people on Twitter want to talk about. And I'm wonder if I really should start to get involved in that stuff or not. Like today, the big thing is, should Elon ban Elon Jet and all of that stuff? And I mean, I have an opinion about it, but I just don't care to tweet about it, Still waiting to see if Lucas posts a link or if he's just got more coming. So where was it? I said 10. I don't think I would be making very much off of this with the micro treasuries, but I think that call at 10 was the right one. Although it also looks like my 10-year chart might be screwed up. I'm gonna try fixing this here. Yeah, we have news and some. It's not. These aren't an early release. Also, remember that the S&P PMIs tend to be less impactful because they're a little bit more delayed. But I mean, it's the best news that we have on a big options expiration Friday. We're still gonna want to pay attention to it, right? There we go. Wish I knew what drove that sell flow, man. It's been a long time since I've seen such a strong flow in the treasury that felt like it came out of seemingly nowhere. Certainly happens all the time, but it seems like it's been a long time, a couple of months since I've seen one like that. There's this article on Jigsaw Trading where the Axie guys were talking about an iceberg trade. And I'm not watching the video, but Alex walks through the action and discusses how you can trade it. He also mentions at one point how he feels it's an imperfect setup, not so much because of what the iceberg is doing, but because of what a correlated market is doing for, yeah. That's exactly it. That's exactly the issue with those trades, right? Well, that's why you just have to factor that into it. Joseph Wing, seems like the very small 15B ECB quantitative tightening. Oh, so 15 billion ECB quantitative tightening has been having a sizable impact on global yields. Okay. I do think after that move, right, since it wasn't driven by news, we have to consider the possibility of a sovereign wealth fund selling here. And as such, we could see further legs at like 8 o'clock after this news, I guess. Come in here to Zero Hedge and check if there's any. A Senate passes 1-week spending bill averting government shutdown. Hawkish ECB sparks peripheral spread blowout that the ECB will have to bail out. Okay. So I'm starting to get the picture that we could see some selling flows that aren't driven by news, but are definitely like a thing. Like, we kind of have to think about the market we had with the whole UK deal. Remember that? I feel like I'm having a hard time finding my words today. That time period where it was like sell the treasuries because of the craziness happening in the UK market, and meant that we would get really strong sell flows without real news driving them. And I kind of sat on the sidelines through a lot of that, but maybe now we might have, you know, we can be a bit more savvy and try and sell this. They're back to the high end of the range. There's maybe a little bit of resistance here, but I don't want to mess with it 2 minutes before news. The news that we're going to get: services PMI, they're looking for 46.5, so that would be a contraction. Manufacturing 47.8. and composite 46.9, which is all pretty close to what the previous month's numbers were. So Bitcoin tumbles as Binance proof of reserves removed from auditor's site. Poland demands answers after gift police chief received from Ukraine officials exploded. What the fetch? Okay. So, nothing too big in the news. Let's just wait a minute. I want to note again that this particular data point is usually not a huge mover. I mean, it's kind of more of a moderate news, but it may be more significant today just because it's like the one big piece of economic news that we have on a really massive options expiration. Also, the services PMI probably matters more right now because that's where we're seeing more inflation. So if we saw services PMI substantially above expectation, that could be bad for the market. Okay, so they're all below expectations. Services was 44 versus a 46.5. You're seeing a very strong bid in the market because of that. Probably could have picked somebody there, but I wasn't ready. Okay. Okay, interesting. I'm gonna reset my DOM here. I'm seeing a little bit of fight in the tape here now. So what I'm seeing here is another data point substantially in favor or supportive of the theory that the labor market is really not as strong as it appears from the labor numbers. So normally I don't know if like 2 points under expectation would be a huge deal in the services PMI, but in this situation it certainly is. It's interesting to me. It seems that the S&P 500 didn't react all that much to the news, but the treasuries definitely did. The treasuries really strongly reversed that whole move. So I took the quick profit there. I could get back in. I was just kind of seeing that the flow was a little bit two ways, so kind of thought maybe in this situation it's good to take the quick profit. Maybe not, man. That looks like some aggressive flow, man. It's a little bit too volatile for my tastes. The fact that the S&P is not really moving here has me a little nervous. Also, I'm seeing a pretty big shooting star candle in the 6J is also making me a little nervous. So if that news like really results in persistent flow here, I should have plenty of opportunity to do something with it. The other thing is we did have that really strong sell flow, and we were saying, well, it didn't seem, it's kind of felt like it came out of nowhere, right? And that there could be other legs if it's like a sovereign wealth fund or something like that. That's so a sovereign wealth fund would love to come in and sell that, right? So I've got to I think that there's some reason to be a little bit cautious about, oh, this is just going to run all day, right? So do you still look at candlestick patterns when you trade the order book? Not really, but I just tend to notice them. I can't help but notice them. Especially those shooting stars. Although at the moment, I'm not sure that that candle qualifies as a shooting star. There was for a moment that it was, but... I mean, the thing is you'll notice I'll point out anything that is like an aberration from the normal. I'll point it out, mostly because I'm bored and I can't help but notice them. I'm not saying those things as like, I think that fact gives you an edge of some sort. 39.12. Oh, this could get so interesting, folks. If the S&P makes it another 10 points, man, that could be something that could be interesting, yeah. I'm not sure if I did the right thing there by taking the quick profit. It did come back to where it went a little bit further, but only by like 5 ticks, and now it's come back 5 ticks. Yeah, I part of me makes me feel like, oh, I took the quick profit. That was me being emotional and like too risk adverse is often what I do in this situation. But again, like the sell that we had earlier gives me a strong reason to be extra cautious here. Yeah. I don't feel that I have strong mastery over my emotions. I'm telling you. I was having so earlier this, like on Sunday, man, it's been almost a whole week. I got really angry at my kids because my stepkids sometimes will treat me like I'm an idiot, or like they'll gang up on me and on things where they don't know what's going on. So like, you know, the baby will make a mess or somebody got hurt and they think that I'm at fault when they didn't even know what happened, right? They just have this tendency to come in and want to try and blame me and scold me. I'm like, you're a kid. You don't talk to me like that. Okay. You're not in charge here. So I got really mad at them. And I was telling my wife, like, you know, my threshold is higher, but when I get pissed, I get pissed. It's not like I would ever hurt anybody or anything like that. Never intentionally hurt anybody. Never create like significant damage or any damage that would like cost us like money. I might like break a pencil or something, but you know, I don't have complete control over my emotions. Yeah, I'm ADHD. People with ADHD tend to have a little bit of a temper. And I do. Most of the time I'm really even killed, but there's like this threshold. You get above that threshold and I fall apart. For sure. And the reason I point that out is because I think that a lot of retail traders think my problem is my emotions. I mean, I've thought that for a time too. My problem is my emotions. And their thinking is I'm not in control of them enough, and so I need to learn to suppress them or something like that. And that's not the way that it works. Trying to suppress your emotions has negative consequences that I think are even worse. Instead, what you want to be able to do is you want to be able to separate your emotions from your actions, which is to say, whatever feelings that you're having, they don't change the decisions that you make. We might be better off leaving this market alone. Yeah, I feel this is a tough one. There is definitely a possibility that this market like catches some real trend, and I regret taking the quick profit on that. But so far, the quick profit on that kind of suggests that I caught a good combination of some informed trading and some technicals there to catch a good trade. And it was a good trade, and I should be happy with it for what it is. It's just, I know that there's always that situation where it can keep running, and I don't want to miss out on the runners, but we have some good reasons to be wary of it, don't we? So I think you're probably right, Lucas. We're probably better off leaving this market alone for a little bit. If there's going to be like more selling flows, they could still come in the next 15 minutes. So if we don't see those selling flows in the next 15 minutes, then maybe we could shift and say, okay, I think that rates are going to decrease a little bit more here. I see that you have no, but I do have FOMO. I'm FOMOing super hard here, right? I'm really worried about, okay, so I got out at 20, right? I would be up at least 5 more ticks here. That's what it was before. This is still the top end of the range. I'm really hyper focused at the moment on the possibility that they go and breach the highs and this ends up being a really strong runner. I have some reasons to think that it might not do that. Just taking a look at the flow, and it's not optimal. I don't know. So let me come over to the chart here and show you what I'm seeing in the flow. We had a really strong sell here that we can't explain. I am concerned. Am I concerned? My best theory is that there could be some sovereign wealth funds, etc., selling here, like pressure because of what the ECB said yesterday and like overall quantitative tightening. That's my theory on what might be driving this. And when that happens, that means you could see some really strong quick flows that aren't attached to any news. Okay. Then we had the actual news move, right? Which was counter, and you can note in the 10-year that there was more buying off of that particular data point than there was selling over here, right? So the issue is that if this is a multi-legged meta order, we could in the next 15 minutes see another sell that would be, it probably wouldn't be as big as this one, but it could be half as much, and it would still kind of push us down, right? And then the split side of that is that people really end up thinking that news was significant, right? And they come up and they breach the highs. So we're close to the highs from the regular session. There is this peak at 26-ish, 26.5, right? But you're right, like we're still really close to like that center point where you get maximum options pain. So I don't know if I should be as concerned about missing out on 5 to 10 ticks as I am right now, but I'm a little frustrated that I've caught this week a couple of good $10 trades, but I haven't been able to get anything bigger than that. I'd say that's somewhat accurate. There was a big sell before the news, There was a little bit of buying just before the news, and then they really bought during the news. Yeah. And the buy during the news was about equal to the sell from before the news. So the thing that we would have to sort out here is like, what's the next set of orders going to be, right? Well, did all of the speculators and people that are willing to buy treasuries here, did they all just buy off of that news and they're done? That's one thing you got to be considers. There's so much buying there. Can they really have continuation, right? For us to really have a continuation, it has to be like people see that news and a lot of fund managers and a lot of money decide that that's reason for it to move, right? Given the current situation, the options expiration Friday and everything, I'm not so sure about that one. And then the split side is, why did they sell? We don't know why they sold, but we do know there was a flow there. And there's a possibility that it was a part of a meta order and that there will be another leg. So those are the two flows that we can see right now that are kind of in competition. And that doesn't give me a clear imbalance to one side or the other to want to try and hold that trade, right? So we took it off. That explains the quick trend. I mean, I don't know if it really does explain the quick downtrend though, right? It could be that somebody was selling for the news and they were wrong. I guess that's a possibility too. Or that there was a piece of news that we're just not privy to. I just heard over the news squawk. I don't know who it was, but they were saying, you know, seeing Russians train does not necessarily mean that Russia is planning on moving on Kiev, is what they were saying. So it's come close, but they haven't quite touched that 3.51, so we're still okay. I mean, it's been like what? It's been like 15 minutes now since we took that, and it's still essentially at the price that we were at. That means that I probably made an okay decision. There might be another move and I miss it, and then it would be like, oh, I should have taken another trade. But I think that getting out there was probably an okay decision. Or they knew it. I don't know, man. You know, one of the things that I see a lot is, because this happens on TikTok a lot, I guess, is we have this tendency to want to make it a conspiracy theory, right? And just what I've found, what my own research kind of suggests, is that the structure of the market is a better explanation for why things go the way that they do, rather than that it's all some play to screw everybody else over. Now, there's a little bit more extended of a down move. So we should watch here. When they sell, how many contracts is it? That was 712, 524. If I start seeing thousands again, because that's what happened before, was it was 1,000, 1,000, and then it just kept going and going and going. Brannigan Barrett's just commenting on the whole Binance auditor pulling their proof of reserves thing, saying the next phase of the crypto saga is about to commence. Could be. I tell you what, this period, so after the Federal Reserve meeting, you don't get a whole lot of economic news in the next week. And then you got Christmas, and the week after Christmas is usually the most dead time of year, and you don't want to trade that. But that makes it the most interesting time of year for something crazy to happen. right? Like if the cryptocurrency market were to collapse in the next 2 weeks, that would be so wild. Like if the cryptocurrency market collapses in the next 2 weeks, I think you're talking about a situation where they could go back to like 5,000 and stuff. Like it could be like really mind-boggling crazy. And I mean, there is news coming out at just the right time, but that doesn't necessarily mean anything's gonna happen. Let's hear. 3 minutes ago, Nick Timmeros, the Fed this week laid out an economic and interest rate forecast premised on a drawn-out battle with inflation completely at odds with the markets. Investors are taking greater comfort from falling prices of energy, automobiles, and houses. Via Greg IP, Jerome Powell's grim inflation outlook is at odds with markets at the Wall Street Journal. This is Greg wrote this story. Chief economics commentator for the Wall Street Journal. We should be following him. Not only should we be following him, we should put him on our list. Yeah. Let's see here. Where is it? Add, remove from lists. Pick a list, traders. Go. Oh, you dropped the paper in Discord? Yeah, let's read that. Okay, that's interesting. You gave me something from the CFTC. Okay, this paper studies high frequency trading in the E-mini S&P 500 futures. So that's okay. So that is the S&P 500 is a really important fact, right? Over a 2-year period. Okay. And finds that revenue is concentrated among a small number of HFT firms who achieve greater investment performance through liquidity taking activity and higher speed, while the median HFT firm realizes an annual Sharpe ratio of 4.3. Wow, really? And a 4-factor annualized alpha of 22.02. Nuts. Revenues persistently and disproportionately accumulate to top-performing HFTs, consistent with the winner-takes-all industry structure. New entrants are less profitable and more likely to exit. Our results imply that HFT firms have strong incentives to take liquidity and compete over small increases in speed. Page 56, you say? Profit breakdown. This table analyzes the decomposition of average daily short-term profits among different trader types in August 2010. The table is constructed by considering the trades between each pairwise group and calculating the profit flows that result from those trades. We calculate each type's short-term profits. The rows identify who receives the profits, whereas the different columns represent from whom the profits are derived. Panel A analyzes average daily trading profits, and panel B describes the profits on a per contract basis. You got HFT, HFTM, HFTP. I'd have to go back in the thing and see what those different ones are. Non-HFT market makers, fundamental, opportunistic, small. Interesting. Profits 2. Opportunistic and small. So most of these have negative numbers, right? Oh well, hold on. I don't understand that. Doesn't that kind of contradict what they were saying here? Isn't that saying that the HFTs are net unprofitable? The non-HFT market maker is profitable, and the opportunistic is where the most of the money is going? Okay. Aggressive HFTs, mixed HFTs, passive HFTs, fundamental, small trader, non-HFT, market maker, and opportunistic. For each month, we classify the rest of the universe of non-HFT firms into 4 different subcategories. Non-HFT, market maker, fundamental, small, and opportunistic traders. I don't know if this is really saying what we think it is. Wow, you got an interview for a junior data analyst role coming up. Kind of nervous. It's my first tech interview. Don't be nervous. There's you don't have to be nervous about job interviews, because either you're what they're looking for or you're not. And so it has nothing, right? We want to think about, or our tendency is to think that whether I get the job or not is a reflection of my value as an individual, and it's not. It's just a reflection of how well what you know matches up with what they need. Of course, you want to perform well, right? But the best way to perform well is to just know that you know what you know and do your best and go into it with confidence. That's how because I tell you what, interviewing at Goldman was crazy hard. They asked a lot of hard questions, but they gave me a job, right? Even in spite of some of the inadequacies that I have, right? Put yourself in a place where it's you interviewing them. Yeah. Anyways, and a big thing that I would say, like, here's the advantage that we have. Okay, is we have a passion for the markets. Okay, if you're doing a technical job or whatever the deal is, I guarantee you, if you have a real passion for markets, the markets is just the thing that you care about and want to be thinking about and doing all of the time. That is such a big step up over most candidates, because not everybody in the finance industry actually cares about finance, right? They definitely notice when you say, yeah, I'm obsessed with the markets. So no reason to be nervous. Hope you do well. So we're still kind of sitting here. It looks like we're actually a little bit oh yeah, we're almost to where I took the original trades. So seeing this come back to like where I took the original trade kind of makes me a little nervous. It does look to me like the sell that we were anticipating came through. It's just that, like, that original one was, let's say, negative 102 to negative 117. So that first one was about 15,000 contracts. This sell that we had after the news is from about negative 99 to negative 107. Is about 7,000 contracts. So the sell flow that I was anticipating, it looks like it did come through, but because of the market and everything else, and it being the second leg, just didn't result in that much movement. But it certainly was the right call for us to take the quick profit and be wary about this, isn't it? Now, I'm curious where we go from here. On the S&P 500 side, there was some buying on the open a little bit, and then of course there was some buying off of that news, but it wasn't too much. But then after that, the flow is turned back and they are pushing regular session lows again. So the S&P looks awfully bearish. Dude, Lucas, you got to explain this to me, man. So I understand that's aggressive, mixed, passive, non-HFT market makers, and then other people, fundamental, opportunistic, small total. Oh wait, this is counterparty. The rows identify who receives the profits, whereas the columns represent from whom the profits are derived. Ah, I see. So they're saying over here, the aggressive market makers receive the most profits. So then this is saying, okay, so these ones are all zero. Who do the aggressive market makers make the most money from? They make the most money from the mixed market makers and the opportunistic people. Interesting. I'm looking over here. Who's the biggest number that I see here is the 15,000. So the mixed market makers are making the most from the opportunistic guys, which I think that we would in this one we would be classified as small or opportunistic, right? I mean, we wouldn't be classified as opportunistic because we're not big enough, but the way that we're trading is probably most similar to opportunistic, or the way that Seth is trading is most similar to opportunistic, right? And they're saying the mixed market maker makes the most from the opportunistic guy. That makes a lot of sense to me, because it's not just the arbitrage thing. It's kind of this wider movement sort of a thing that goes on. Okay. What about on a per trade basis? What's the most HFT passive against small traders? Okay, so that is in line with what we would expect, isn't it? Okay, but again, that this was done on S&P 500 futures, I think is really, really, really important, right? Because there's a lot of effing noise on the S&P 500 futures, and the kind of HFT strategy that you might be doing for an S&P 500 future is probably going to be pretty different from the kind of HFT strategy you're going to be doing on a treasury future, right? Because over in the S&P 500, a lot of that is going to be like, what is the stock price of every component, and ergo, what should the S&P 500 futures be based on that, combined with the basis difference that's caused by the borrowing rates and all that sort of stuff, right? To calculate the correct price, and then when they're too far off of that, coming in with strong market orders and pushing it back to that price, right? That's kind of what I'm thinking of when I think aggressive HFT, right? In S&P 500 futures. That might be different in treasuries. So we should really, really take, if we're not thinking primarily, or rather, which is to say, I think that we should not extrapolate this to mean something about order flow in general, right? Because we don't know that. We can't know that from the data that we have. We can only know that it makes sense to be the aggressive one in the spoos, right? Name of the previous song? Which one? This one? Smooth Deception. I'm gonna give it a like so we can find it better. I'm not sure how much HFT is present in UST, to what degree and how they operate. No robot will push that market around, right? Well, I mean, I think that there are definitely market makers that come over here in the treasuries and say, there's only 50 on offer and we're trending up, so I'm going to buy here and then try and exit here. I'm sure there's definitely tons of that. Right. But the strategies are definitely different, right? So let's not say treasuries, let's say oil, right? Because oil moves around a lot. How much do the passive market makers in oil make compared to the aggressive HFTs? Might be different. We don't really know. Just the fact that it's only in the ES is kind of like a really big limitation in this study, right? I wonder if they oh, here we go. Okay. One limitation of the paper is that our profit calculations do not account for all of the costs of an HFT firm. While we know such direct costs of trading as trading fees, the cost of direct data fees, cost of co-location, we cannot adequately calculate other costs such as computer systems, labor, risk management systems. We report gross trading revenues throughout to limit speculative assumptions from influencing our findings and because our focus on trading performance. Ooh, so that's really is a key point as well, is that they're saying maybe it's harder to be the aggressive market, the aggressive HFT. It costs more, and maybe those people don't actually make more when you factor in all of the costs possible. I definitely know that there are costs associated with it, right? Conclusion. We study the risk and return performance of HFT firms. We document several important descriptive statistics, many of which suggest superior investment performance of HFTs. HFTs can earn Sharpe ratios that are several times higher than those for other asset classes or trader types. HFT returns are highly persistent while risks are kept very low through tight inventory control and rapid turnover of contracts. HFT profits accumulate to the fastest and most aggressive liquidity-taking incumbents, while new entrants are less profitable and more likely to exit. These facts highlight the importance of understanding the organization of HFTs. Economists generally think that competition from new entrants will improve markets. There will be more liquidity, greater price efficiency, lower transaction costs for investors, and less potential for any one firm to influence markets. However, the cutthroat competitive environment in which HFTs interact may influence their impact on market quality. With limited competition from new entrants to engage incumbent HFTs, market quality may not improve as much as it would otherwise. Recent theoretical papers have highlighted concerns of faster traders adversely selecting slower traders and competition on speed, leading to socially inefficient arms races for speed. Our results suggest that HFTs have strong incentives to take liquidity and compete over small increases in speed in an industry dominated by a small number of incumbents earning high and persistent returns. Understanding the industrial organization of HFTs allows researchers to think more comprehensively about the role and implications of HFTs and financial markets. No firm is 100% passive or 100% aggressive, right? They work both sides. I think that there are, I don't know, man. I'm not sure. I guess the thing is there's a couple of things there. Oh, by the way, they pushed back up there, huh? I guess they would have given us an opportunity to go short at 3.53 again. And given that we had that sell flow already, sure, we're good to move up. I do feel like it's maybe a little bit late in the day, so I'm not too bothered by it. If this ends up going like below 3.5 and then some later in the day, though, I'll probably be a little frustrated with myself. So I guess what we're saying though is like, so the couple of caveats. One, it doesn't factor in costs. Two, this is only on the S&P 500, so other instruments might be different. But another caveat here is that they are really talking about high frequency trading. I mean, real high frequency trading. So whether that means that we should be trying to use market orders or limit orders, because I think that that's where it comes into application with us. This doesn't necessarily tell us that, right? Fact, what this is kind of saying is that the thing that works the best is being the one that's able to pick off like that small pricing in something. And in order to do that, you really truly have to be one of the fastest out there. So that's something that we as retail traders simply are not competitive with, right? So I don't know if it really says anything about how we should trade, right? How did this start? Oh, because you were saying your theory was it's all about market orders, right? Well, this study is a lot more limited than that, right? They're saying that the one of the most profitable best Sharpe ratio strategies is being an aggressive HFT. Something, so that would mean you would want a strategy where you're catching a teeny tiny little order, a teeny tiny little profit off of some sort of a mispricing using market order. And in order to get these trades, you probably need to be co-located and really fast and all this stuff, right? And an aggressive, yeah, the problem is that toxic flow still ends up being like probably too broad of a category of stuff, right? Because there's like toxic flows and then there's these aggressive HFTs. So what percentage of those aggressive HFTs are actually the toxic flows, right? But from my perspective, that's where I'm saying, like, how do you define what flow is toxic or not? Like, can you give me an indicator that shows you number of toxic orders on each side or something like that, right? I don't know how you define that per se. I think that the term toxic flow is maybe a little bit more theoretical than we want to admit sometimes, right? Informed flow, though, is something that we can't quantify, but we can very clearly define, right? People who know something that is likely to lead to future orders. That's an informed order flow. For my strategy, I'm more interested in trading ahead of informed flows. Yeah. And when I do, I prefer to use a market order. Yes, I do. Although that trade where I caught $10, I do believe was a limit order, right? I have to add another tab here. Orders. Yep, they were both limit orders. So, Seth just lucky, I guess. And what time was it at, too? Placed 38 seconds after the news. Oh, wow. So I probably could have made a lot more on that if I had been faster. Well. Whoa, we got 30 minutes left. S&P 500 did come down to the lows. It looks like things are a little bit more varied here. A bit of back and forth across 38.80. So still not able to make much of a conclusion about what SPOOs are going to do. No, I don't think so. From my POV, this means huge spikes of volume that come out of nowhere. If you think about it, these things happen. If you have a market that moves 15, right, then that's toxicity. Well, I think, are you saying it's just when you have a lot of one directional flow, then that's toxic? Or are you saying, you know, the flow kind of coming out of nowhere is, and maybe isn't even actually have anything to do with anything, is toxic? What's the maximum pain trade in this booze? Okay, so the highest amount of gamma in the S&P 500 is at 4,000, but we're well below that, so I don't know if how much that particular metric helps us in this situation, unfortunately. Kind of the thing though is that coming into the equity market today, again, some CTAs could be coming in and piling in, but I'm not sure I see too much evidence for that in the S&P today. Do we? So, no, you have a market rhythm. Anything that breaks that market rhythm and flow is toxic. Yeah. See, what it sounds to me like you're saying is that the toxic flow is intentionally designed to push the price and screw other people over, right? But I have some issues with that kind of approach, because just coming in or let's put it this way, defining aggressive HFTs as HFTs creating small ignition events, right? So an ignition event is you identify a market that appears to have some positioning built up, and so you come in and you try and spark a move with a couple of market orders by pushing price, and then hoping that the other participants flood in after you and continue to push the market up while you exit, right? That would be like an ignition event. And the reason why I'd have issues with that is because in a regular regulated market, an ignition event is not really a profitable trade, because if you're selling into them, your impact tends to move it down more. You leave a huge liquidity hole, and there's just like lots of problems with that, right? So what I'm saying is I think, especially when we're talking about SPOOs here, I think that an aggressive HFT is probably more, based on my calculation of what the S&P 500 should be, it should actually be 38.74. So I'm going to sell with market orders at 38.75 when the bid is looking weak, and there's going to be enough overall market volatility for me to get filled at 38.74 where it should go to. And in that situation, being extremely fast is going to be very, very important, right? That's what I think aggressive HFT probably means. Well, so let's just come back in here, because they do define it, don't they? Related literature, data and methods. Oh, okay, so this matters. We use transaction level data with trade identifiers for the E-mini S&P 500 stock index futures contract. Our data set spans over 2 years. The E-mini is favorable for the following reasons. First, it is an important and highly liquid market with several different types of market participants regularly trading, including a high number of HFT firms. The E-mini is the second most traded futures contract in the world with a notional volume of approximately 200 billion per day. Hasbrook shows the E-mini futures contract is the largest contributor to price discovery process of the S&P 500 index. I would like to go and read that study. The second, the contract is in net zero supply and buying and selling are symmetrical, so there are no short selling constraints. Third, because the contract trades only electronically and only on the Chicago Mercantile Exchange, there is no concern about unobserved trades happening on other exchanges. No designated market makers nor market taker fees or liquidity rebates. Our data set is trade by trade and contains common fields. Where did they get this data from? Canceled and other irregular transactions are filtered out. Categorizing traders. We define different trader types based on two selection criteria: inventory and trading volume. HFTs are identified as those firms with extremely high volume, low intraday inventory, and low overnight inventory, and confirmed by us by analyzing all market participants along the dimensions of volume and inventories. HFT firms stand out as a distinct cluster with daily trading volume orders of magnitude higher than other traders. In addition, we use the aggressiveness indicator assigned by the matching engine to group HFT firms into three categories. Okay, so aggressive does mean they're more likely to be using market orders, essentially, right? Median trading volume, end of day inventory, intraday inventory ratio, and aggressiveness ratio. Okay. We find that the majority of HFT firms consistently specialize either in liquidity taking, aggressive HFTs, or liquidity provision. Okay, yeah. Or to put it better, bigger, there are some people that make money by putting limit orders at practically every price and managing an inventory throughout the day that they probably close at the end of the day. Whereas there are other people that specialize in very, very short-term order flow signals or arbitrage signals, and use market orders to go and grab those, right? Make it more clear if that's possible. For me, toxicity speaks to disruptive behavior of current standard average order flow. How this happens is through market orders gaining prevalence. Okay, so if what we're saying is, if I have a couple of different indications, what is the current limit orders at a price, how much absorption is happening, etc., versus cumulative delta? Cumulative delta is a more useful metric, yes. I think that is true, and the study does seem to support that, right? I really want to know how they are, where they're getting a data set that matches up all professional traders, the trades that they've taken and who did it and stuff. There's some information about where this data set is coming from that is really valuable, right? By the way, we did come up like to the highs here, 18. There seems to me maybe some resistance at 18, or at least the liquidity hole at 18, because a lot is traded there. But we're kind of going sideways and even maybe pointed down a little bit. So I think that also, once again, we could have made $10 from this range again, but it does kind of suggest to me that the flows that we were thinking about were not going to be very persistent, and that we were again not we made the right choice by getting out. Oh, it's the CFTC. You're right. That's true. Even then, there's still a lot of information about the actual data set that they're not telling us, right? Because you're right. Like it would have to be like data of everything that happened on, or let me back up. Let me put it this way. I did not think that this data set existed, right? A data set where you can look at every trade that happened in a 2-year period and attribute them to individual actors. Is wow. That could, because we've had that kind of a data set for like the Taiwanese market, for instance, and a lot of studies about the profitability of traders and so forth have been done on that, but not like this. Not for such a developed market and a futures market and all of that, right? So I guess small. Wait, where were we? Okay. Small traders have a median daily trading volume of less than 20 contracts. So if we traded in that year, our accounts probably get categorized in this as small, right? Oh, actually, it might not be that. You know what? It's probably not like every transaction that's happened in the market. It's probably just every transaction that's happened from CFTC reporting firms, huh? So like the retail traders are probably not represented or included in this at all, or speculators. It would only be people that have to report to the CFTC. Still. Oh, I want to go back up there. I keep like, okay, I'm here and then I'm here. This is ADHD, man. Aggressive. Mixed. Have a mix of the two main categories. Non-HFT market makers are non-HFT market participants who have an aggressiveness ratio less than 2%, inventory ratio less than 15%, and median trading volume of at least 20 contracts per day. Fundamental trader category is meant to capture large institutional traders who adopt buy and hold strategies. They have a trading volume of 1,000 contracts per day, end of day inventory ratio greater than 30%. The small trader category likely captures retail traders. Small traders have a median daily volume less than 20 contracts. Note that HFTs and the above three categories are all mutually exclusive by definition. The remaining are defined as opportunistic. Captures either medium-sized buy and hold investors, not big enough to be considered fundamental traders, or large traders who, unlike fundamental traders, move in and out of positions throughout the day, but with significantly larger fluctuations and with lower frequency than HFTs. So if I was a large enough firm, I probably would be marked as opportunistic, right? Right. Just because Sorry, which page are we on? 56. 56. Just because it seems like it's the opportunistic people that are losing the most. Opportunistic small loses, and then non-HFT market maker. Do you ever have technical analysis relapse? I think I do. I mean, I think that I seem to notice things that would be technical analysis more than other people. But I very actively avoid making any decisions based on it. Anyways. But I mean, another takeaway from this, if we're trying to look at this from the perspective of like which strategies are profitable and like is day trading profitable, that sort of a thing, what it says to me is that the robots are the only ones really making money. According to the CFTC, the robots are the only ones making money and everybody else are net losing. So again, unless you're like the fastest. Yeah. Large trader reporting system, which gives us access to end of day positions of all reportable accounts representing 80% of open interest. So I'm saying they were saying that this mostly likely represents like retail traders, but it would only be reportable ones. So it would only be the people that are like the big hitters. So isn't that interesting? That even when we talk about these guys that are like big hitters in futures, they're net losing money. That category as a whole are net losing money. It kind of you know what I mean? Like the takeaway from this, that like the end takeaway is don't trade unless you're in HFT. And you're the fastest HFT, right? But like from an order flow perspective, the issue I have here is that I'm not so sure that suggests something empirical about the profitability of like market orders versus limit orders, as they're trying to say. I think it has more to do with the exact nature of the strategy that they're trying to do, and it just happens that the strategy, at least in current markets that are most profitable, happen to use market orders, but we don't actually know why that is. We'd have to be able to look at all of those different firms and analyze their actual strategies, right? So it doesn't suggest that there's something about the market microstructure that favors market orders. That's what I'm saying. An interesting avenue of research, though. Well, what we got? We got about 10 minutes left. I guess I'm not going to be able to see the conclusion of this in the S&P. We'll definitely be watching it in Discord today, because where the S&P 500 closes today is going to be really interesting. I bet you that the market on close imbalance today is going to be massive. It's going to be like one of those 3 to 6 billion days. Yeah. Another thing, like going off of all of that study that we just looked at, like another thing that I want you guys to take away from that is that usually what we can really measurably prove from a study is very limited, right? So that doesn't mean that you as a trader can't kind of extrapolate more from that information. We just have to be very careful about when we're saying what's proven and what's not. Like what's proven is like very, very limited in scope, because it takes a lot to prove one individual thing. And, you know, I would be interested in like any paper that cites that paper, right? To see what avenues they take that next, because it certainly to me it leaves more questions than answers. Yeah. Well, let's come back over here to Twitter and let's make sure that I didn't miss anything. Nope, not much. Wait, what? Oh, there might be some stuff. Okay. YouTube is making some interesting changes for streamers. YouTube streaming update. They'll make it easier to find live content on the platform. Yes, please. Big updates coming in 2023. People complain that it's hard to find streams on YouTube, so when they fix that, geez. YouTube is working on improving the live chat experience for streamers. This will be huge for building culture. I bet a lot of Twitch streamers switch to YouTube in 2023. So you're gonna get into more details about it? Okay. Updates to moderation tools with YouTube live chat too. It sounds dope AF. You'll be able to see chatters' previous actions, chat history, timeouts, etc. That'd be good. YouTube is working on ways to edit together your gameplay and face cam from the mobile app. This will be huge for people who create shorts directly from videos already uploaded. Let's go to this guy and see where this information is coming from. Did you see that foreign investors are going to be taxed 10% on ETFs and other types of funds? I've received this list from TradeStation. Oh, really? Where did that rule come from? I'm wondering about that one. I mean, you're saying that they're doing something that would strongly encourage foreign money to invest in index funds in their own countries, right? It's like 10% on index fund. Like that's a ton, right? That's like, think about that. If you make like if we say that the stock market makes 7% per year, right? And we times that by 0.9. That means that takes your actual take-home profits down to 6.3%, right? At that point, you almost might as well buy bonds. It's like not quite to that point, but it's a significant amount. YouTube says channels uploading both shorts and long form are seeing better overall watch time subscriber growth compared to channels that only post long form. I should probably make more like YouTube specific shorts. But you guys, I made a video. It was like, here's what I talk about, but nobody responded, left comments on it. So don't know what stuff to make. Anthony, that's contrary to, yeah, I don't, Kyle is just getting that from trade stations, so there's probably a lot more information we should know about that before we make any too big of a conclusion about that one. YouTube is working on fixing the spam issue in live chats. Oh, that's interesting. YouTube sends 3 notifications to subscribers for a channel's activity per day. Now when you upload a short, it won't count towards your daily notification limits. Okay. So that kind of means like you would want to post as many shorts as possible because it will mean that you get more notifications to your subscribers. New moderator role. This is all 2 days ago too. Well, it sounds like we might get some stuff from YouTube that might help us. Oh, there you, I was waiting for you to step in, Akshay. You're like way too late. So I got something for you. I made you something. It is the Federal Reserve President's tier list. Let's see here. You can do S, A, B, C, F, and I don't know who that is. And then you got all of the different Federal Reserve presidents. Now let me show you a little trick here. So if you come in and you like right click on one of these pictures and go inspect, right? And then there's this dot character class that has the width and stuff. So if you change this to, let's see here, 110 px and 175 px, I believe, then we should see. Oh, I think I'm gonna have to close this just because I don't have enough. It's not wide enough there. Now it makes the pictures a little bit bigger and you can see their names underneath. I was busy crying after being rejected by a girl. Oh, I'm sorry, actually. Don't worry about it. So you know what I did that day is I was like, okay, there are a lot of these guys I don't know who they are, so I should go and do some research about them. But what I found was that like there's just not a lot of information about some of these guys. And I went and I found a book that is like this expanded history of the Federal Reserve by this guy that like went through all of their documents and everything. It was like in this insane book. I was like, whoa, like I need to get that book, but it was an expensive book and it looked like it was a heavy history book. So it was like one of those things where like there was a comment from somebody on Amazon saying like, basically this is the only person on the planet that knows enough to like write a book like this. And so like, it's hard to even like proofread and like verify the information and stuff. But so there's like, he pointed out a couple of instances where the author made a mistake, like they wrote something wrong or, you know, like a syntax kind of a mistake, but it was an interesting book. Anyways, so like I can come in here and I can be like, so here's saying, what is it? Hamlin. So you got Hamlin and Shat. Oh wait, that guy is not on here. That must be somebody from the UK, huh? Von Havenstein and Norman. Those are non-US central bankers, aren't they? Ben. He's a Ben Bernanke. So let's just pull in the people that we should know. Volker, Yellen, I'd say Eccles, Greenspan. Yeah, so these other guys are people that I don't really know. Arthur Burns, that sounds awfully familiar, but I think he was before Volker, right? I don't remember who he is, though. So, like, when we come in and we try and rank them, so it's like, okay, Powell. I tell you what, if we get a soft landing, then Jerome Powell is like S tier, right? But I think under current circumstances, I'm gonna have to say maybe he's B because he's made some big mistakes. Let's put these down here. I think he's made some mistakes. It's really funny that like Ben Strong. Oh, okay, that's not somebody on the list, my friend. Or maybe you're talking about Fed members, but not presidents. This are only presidents, right? So it's the same thing with Ben Bernanke. Like, I think that Ben Bernanke we could say is A, but like the reason that he did so well was because he fucked up really bad, right? This is the common thing is like the biggest achievements in central banking often come off of the biggest mistakes in central banking, right? Yellen. So Yellen one is interesting because nothing too bad happened while she was in and everybody just liked her. So I think some people like at the time, I tell you what, at the time that she retired, I think that most people in the market would say that Janet Yellen is an S. Like everybody was saying money mommy and all of these sorts of things, right? But since she's become the secretary of the Treasury and kind of has been involved in being the yes man for all of this stupid shit that the Biden administration has done, I'm kind of thinking maybe Yellen is actually an A tier. Maybe Yellen is actually an A tier, right? Volker, though, Volker is an S tier, don't you think? Don't you think Volker is an S tier? Because he was the man with the gumption to stop inflation in the 70s. Okay. Eccles also, I think Eccles is an S tier because the reason you put Eccles in S tier is because he's had such a huge impact on how central banking has actually evolved, and he really redefined the central bank's role in the economy while he was in. So that's why like all of the buildings are named after him and stuff. He's totally S tier. I put Hamlin in here. Why did I put Hamlin? I don't know who that is. Greenspan. I don't know. I liked Greenspan. You put Volker is in the who list? There you go. All these guys are in the who list. I don't know who they are. I'm gonna know who they are though. Someday. Ed Greenspan is another who in the list. I mean, I remember as a kid knowing who Alan Greenspan was, but was he really that big? I mean, some people really didn't like him. Like, if I was a Democrat, I would be like, Alan Greenspan, C. Jerome Powell, C. Janet Yellen, S tier. Oh, yeah. Ben Bernanke, S tier. Eccles, maybe we need to be here. Volker, I don't actually think Volker is. He's overrated. If a Democrat Seth, that would be the Democrat Seth central banker ranking. But here, you can do this on your own. I'll put here in the chat here the link so that you can go in and make your own ranking. And just remember, like, right click on the picture and do inspect, and then change the size of the picture to be 110 by 175 so that you can see the names. And then you can like change it and then send me share it with me. Like, what you should do is share it on Twitter. I'll tweet it out. Allow me to present the Federal Reserve President's tier list maker. Helps to inspect the pictures and change the size to 110 px buy 175 TX. Share with me your lists. So you make them and tweet them back to me, all right? I don't want to see what you guys come up with. But it's time for me to go, so I will see you guys Monday. Be careful here the rest of the day. It could still be crazy, all right? And then Monday, it also could be like crazy, the opposite direction. So we'll see. Stay excellent, team.